Hey everyone! If the stock market feels like some complicated exclusive club you're not invited to, well, you've come to the right place. We are going to break it all down and give you the absolute essentials to get started. Let's dive right in. Okay, let's kick things off with a question that might sound a little intense. Why are savers losers? It sounds pretty harsh, I know, but it gets right to the heart of why investing is so important in today's world. See, just stashing your money in a savings account, it might not be the safe path to wealth you think it is.
And this right here? This is the reason why. This isn't just some catchy phrase to scare you. It's a cold, hard financial reality. The cash you have tucked away is slowly, quietly losing its power. Every single day, there's this invisible force at work, making your money worth less and less.
So, what is this invisible force? Well, it has a name: inflation. And that's why investing isn't really about some get-rich-quick scheme. It's about defending the value of your hard-earned cash. And, just as important, it's about giving your money a real chance to actually grow.
So, what exactly is inflation? Put simply, it's the reason a dollar today doesn't buy what it could a year ago. Imagine the price of everything, your groceries, gas, rent, goes up by, say, 5% in a year. Now, if the money in your savings account only earned 3% interest, you didn't actually gain anything. In fact, you've lost 2% of your real-world buying power. You're falling behind. So, how do we fight back? How do we beat inflation? Well, one of the most powerful tools out there is owning stocks. But what even is a stock? It's a word that sounds kind of formal and intimidating, but the actual idea behind it is incredibly simple. Let's use an analogy to make it crystal clear.
Seriously, it's that straightforward. When you buy a stock, you're not just buying some random letters on a screen. You're buying a tiny, fractional piece of a real business. If you buy one share of Apple, you are a part owner of Apple. So think of a whole company as a giant pizza. Each share of stock is just one single slice. And as an investor, your goal is to buy slices of pizzas that you believe are going to get bigger and more valuable over time. Okay, so if a share is one slice, what's the whole pizza worth? Well, that's what you'll hear people in finance call market capitalization, or just market cap for short. And the math is super simple. You just take the price of one slice, that's the share price, and you multiply it by the total number of slices that exist. That final number, that's the total value of the entire company, at least according to the stock market. All right, so you get what a stock is now. It's a piece of the pie. Now for the big question: which pieces should you buy? As a beginner, this is your first major choice. Are you going to try and pick that one perfect slice of pizza, or would you rather own a tiny little bit of a whole bunch of different pizzas all at once? And this right here really lays out that classic trade-off. On one side, you can buy an individual stock. Now, all your eggs are in one company's basket. If that company skyrockets, well, you're going along for the ride. But if it fails, you could lose it all. The other option is an ETF, which stands for Exchange Traded Fund. Just think of it like a pre-packaged basket that already holds stocks from hundreds, maybe even thousands of different companies. It instantly spreads out your risk and takes way less effort. And you can see right here why ETFs are so popular, especially for beginners. With one single click, one purchase, you get what's called instant diversification. They're usually really low cost and super easy to manage. And a lot of them just track a major market index like the S&P 500. By buying one of those, you're not betting on a single company. You're essentially betting on the success of the 500 biggest companies in the US all at once. Okay, so we've covered the what and the why. Now let's get into the how. How do you actually do it? How do you go from having cash in your bank to owning a piece of a company? Let's walk through the actual mechanics of placing your very first order. When you go to click that buy button, you've basically got two main choices. The first is a market order. This is the simplest. It just tells your broker, hey, I want to buy this stock right now and I'll pay whatever the going price is. It's fast, it's easy, and it guarantees you get the stock. A limit order, though, gives you more control. It's like saying, I only want to buy this stock if the price drops to a specific target that I set. You name your price, and the order will only go through if the stock hits your number or lower. We're in the home stretch now, and this last piece of the puzzle isn't about which stock to pick, but about having the right mindset. You see, successful investing is not gambling. It's a long-term game. It's about managing risk, understanding the potential rewards, and knowing the rules, especially when it comes to taxes. So let's talk about that word, risk. In investing, it just means there's a chance things won't go exactly as you hoped. And yeah, that includes the chance of losing money. But here's the key thing to understand. Risk isn't just a bad thing. It's the entire reason you have the potential for a reward in the first place. The market basically pays you for being willing to take on that uncertainty. The principle is pretty simple. Generally speaking, no risk, no reward. Now, let's say things go well and you eventually sell an investment for a profit. That's called a capital gain, and yep, the government is going to want a piece of that. But here's a crucial tip every beginner needs to know. How long you own the investment makes a huge difference in your tax bill. If you sell within a year, your profit gets taxed at your high regular income rate. But if you just hold on for more than a year, it's considered a long-term gain, and it gets taxed at a much lower, much friendlier rate. Patience can literally save you a ton of money.
So, speaking of patience, what's the potential reward for playing the long game? Well, there are absolutely no guarantees, of course. But historically, the US stock market has delivered an average annual return of right around 10% over the long haul. Now, some years are way up and some years are down, but that long-term average is just a powerful reminder of the wealth-building engine that patient investing can be.
So there you have it, the whole shebang. Why you should invest, what a stock even is, how to choose your first investment, and the core ideas of risk, reward, and taxes. We've laid out the basic roadmap for you. The only question left is, what's your first step going to be?